Nice. What's going on, everybody? Really excited to be here. This panel is all about talking about alpha, and I don't think there's a better group of people to talk about this with, especially current market, what we're going through right now, than the guys we've got up here right now. I know we don't have a ton of time, so I think we should just hop right into it. Obviously, you can do intros and stuff, but I think in the context of a bigger question around, a lot of you have been investors in this space for a long time. What would you say is the biggest difference investing right now compared to maybe 2021 or any of these prior cycles? So we can start with you, and then we'll just go down the line.
Yeah, so one of the things that is cool is that revenue was sort of a dirty word back in the day, and we didn't really talk about it because there was none. And now, obviously, the meta is how great is it that the three biggest companies by revenue per head are all crypto companies. So that's kind of an interesting and fascinating turn of affairs. Turns out we can actually underwrite revenue. People are looking at hyperliquid, and they can actually there's multiples. So this is just a total different meta that I think is kind of fascinating. Is there alpha in that or not? I mean, I don't know, but the main thing is a very welcome change as an investor to actually have some revenue at the end of the rainbow and have these massive companies growing extremely fast, extremely efficiently, and with very small teams. So that meta narrative is just totally new, totally different, and just takes a different type of underwriting. And it, I think, sort of explains why this cycle has been so different from past cycles. And the other portion of the explanation is also, obviously, that is an institutional-led bull cycle, if you want to call it a bull cycle, where institutions just behave very differently and buy very different things from retail. And traditional finance is 80 to 90% institutional, 10% retail. Crypto is actually 80 to 90% retail, 10% institutional. Those things are going to converge, where crypto has to look a lot more like traditional finance in terms of ownership, because the institutions have all the money. So that also makes the behavior in this cycle behave very differently.
Yeah, honestly, signs of a market maturing. People, are looking at these tokens launching. 70% of Binance launchpads are down from initial listing. The market's getting more efficient. You can't do the low float, high FTV stuff people used to. Supply control doesn't mean anything when people can short you on 25x futures, right? Without owning the underlying. So good luck with your supply control. Price discovery is happening, even with a low float. And, focus is on better products, not better crypto products, better products, period. If it's not if it's a robotic horse when cars exist, no one is buying it. So I think it's painful on one hand, the game's up for some of these old players, but at the same time, it's bringing a new breed of builders like Axiom, doing more revenue than the entire YC batch that they're in combined. So now Silicon Valley and tier one builders are okay, crypto used to be a dirty word, but these revenues are real. Circle's a top IPO on Wall Street in 5 years. CoreWeave started out as a crypto company. So people, even if they want to fade it, they can.
Also, to add to that, before Tom goes, before 2025, we had exactly 0 M&As over $1 billion in crypto. 0 in 15 years. This year alone, we had 5. And so it went from 0 to 5, and there's going to be 2 or 3 more until the end of the year, likely. And so this is happening. Equity has value too. And before it was only tokens that had value, and so that matter has also changed. People are making money on equity in crypto companies with IPOs, but also in the private markets, and that just changes the dynamics of investing, because now we can underwrite equity because there's actually just private market examples of, we know there's liquidity at the end of the rainbow.
Yeah, I think those guys hit a lot of the big points. I think it's just so much more real this time. I think in 22 you could, or even in 2021, you could just raise it on a dream, raise it on an idea. I think the overall quality of founders was on average probably lower. I think now it's people are using crypto in service of some other problem, some other product, and it's kind of spawned this whole class of companies that are Web 2.5, where it's kind of normal Web 2 on the front end, and then using crypto on the back end, maybe using stable coins, maybe even something I look at something like Polymarket, where it's it's actually all on chain, right? Every single trade, every single resolution is on chain, but most people using it don't know that that's actually what's happening. And so I think you could have gotten away 5 years ago with, hey, it's decentralized X, but it's we have some token, or there's some crazy tokenomics, and now it's I think those people, you still see them, but it feels like they kind of stepped out of a time machine. And I think that as a percentage of the industry, they're just much, much smaller.
Yeah, I like to think that over these cycles, in that period, it was kind of a bit of innocent until proven guilty, right? Back in the prior cycle. Now it's a bit more guilty until proven innocent, right? To all of your points. Markets matured, investors are a lot more sophisticated, founders are a lot more sophisticated. There's not as much. The BS signals go off a lot faster, right? And everyone kind of knows what to look for. Staying on this topic, again, this conversation all about alpha. So I have to ask, what do you guys think is the most underpriced or undervalued crypto asset or sector right now? Tom, maybe we'll start with you.
Well, I will say my answer last year was
Your answer is Perps Texas, right? Right?
No, yeah, well, it's always a good answer. My answer last year actually would have been exchange tokens. I think exchange tokens were like insanely undervalued last year, and like there was this weird stink about them, which is why a bunch of capital would not actually buck up and buy it. Now I think it's everything in iGaming. A lot of VCs, a lot of investors can't or won't touch iGaming, but I think that is increasingly changing, especially as like you look at what's happening with sports betting and sports futures and like that going mainstream. You look at like online casinos; these are like insanely high revenue businesses, insanely high margin businesses, but like just can't kind of catch a bid from like certain types of allocators. I think that will just change over time, especially as investors get younger, as they become more regulated, as it becomes more buttoned up. So there's no reason why companies these good, I think, should be so cheap.
For me, definitely on the spot trading side, on-chain trading, and some of the innovations that are happening there around like spot aggregation. People are not clued in. Liquidity keeps getting fragmented across these different like modern high throughput chains where first you had vanilla AMMs, then you had CL AMMs, now you have prop AMMs or dark AMMs that are just market makers doing, moving what was passive liquidity to now active liquidity. They're aggregating off-chain liquidity on-chain as well through RFQs and their own quotes. And the spreads are getting super tight to the point where you can swap and trade on-chain more cheaply with better execution than on a centralized exchange for like the top 5 to 10 pairs, which is pretty crazy. Now, you think about retail, they don't really care where they're getting routed, they just want the best price. So there's going to be front ends that are aggregating all these quotes and finding the best price that are going to be doing crazy amounts of order flow, and it's going to be super valuable. And one anecdote to illustrate that is for 2 consecutive quarters in 2021, Robinhood was selling their crypto order flow to a couple big market makers. You could probably like guess who they were. I'm not going to name them. And they were making more money from the crypto PFOF than the equities flow, which is crazy because crypto is a small fraction of the US equities market. And now this game is happening again, and then the DEX dominance keeps breaking out, keeps going up higher and higher. Specifically for spot, I think it's incredible.
Well, I guess as of 2 weeks ago, I can't say privacy anymore, right? Because Zcash is, is up there, and the privacy narrative is the new meme.
Why didn't you tell us earlier?
That's right. So, but as of 2 weeks ago, the answer would have been privacy. I think now, it's sort of the layer underneath this, which is, I think there's something interesting about the fact that there's all of these vertically integrated layer ones and all these corporate chains, and the reality of this is that all of them have different amounts of openness. Many of them are actually succeeding. People don't see it, but there's real revenue in some of these like corporate chains that are actually moving crazy amounts of volume on their chain and their like, the little private pools. And there's messaging and aggregation that needs to happen to this point, and basically like these chains have to communicate with one another. And I think the meta for a long time was that these bridges, the insecurity of them, the lack of pricing ability, there's been a race to the bottom on pricing. They're totally unable to generate revenue because there's a race to the bottom type situation. I think that has been way overblown, and at this point nobody's really looking at them, but I think that can be a comeback because I think the market has more of a need than it's ever had before. The aggregation is necessary. There's more and more fragmentation, and you will need safe partners for message, for aggregation, for intents, etc. So there's something here right now that is still underpriced on how the future market structure will exist if, and the assumption here is that we continue seeing this sprawl, we continue seeing these corporate chains, we continue seeing these types of like vertically integrated ones. We will need to communicate amongst them. There will be massive businesses built there. So I don't think people are focusing on it because they've sort of like discarded them as like unsafe things on one side, or they will never be able to have pricing power on the other.
This concept of kind of filtering out signal from noise, right, is something I think all of us try our best to do, and we all have our own kind of processes or workflows for going about it. I'm really curious to hear, is there anything that either crypto Twitter or you've seen other investors become, I don't want to say obsessed with, but argue about, debate in public spaces that you think is not really very relevant or doesn't actually matter nearly as much as people kind of put weight on it, right? And this could be something around, we talk about privacy, or we talk about real businesses that are starting to create or use, blockchain rails and tokens to create flywheels. But what ends up mattering is distribution more actually important than having the best tech or the best product? Like, are there things that you guys see people debating that actually they should spend less mental time on or mental space on and focus on the things that matter?
Kind of a hot take. I think stablecoins are, people focus so much on stablecoins, they think of legacy projects like the Gen 0 and the Gen 1 Tether Circle. It's less about stablecoins and more about what you do with them. They're more of an implementation detail in the product than they are a product in and of themselves. And now there's comprehensive stablecoin regulation. Corporations are not going to be able to issue them directly, but they're going to work with the guys like Paxos and others to do stablecoin as a service.
Anchorage.
And Anchorage, okay, just to put them on. But actually, it's when everyone has a stablecoin, then it's just back to TradFi. It's a float game. You want to monetize and remonetize a float, do a Starbucks-style loyalty program. It looks much more like traditional business, and definitely there's going to be interest, pass-through, sharing, so on and so forth. So for me, it's look, stablecoins are cool, but at this stage in the game, unless it's a structured product, which is a little more interesting, like something like Athena is more interesting to me, I'd say generally it's less about stablecoins and more about what you do with them. Is that float generating real yield? Is it fee-paying volume? Is it being productively employed with a high velocity of money?
I think token distribution and token cap table management stuff, people love to hand wring about, when I think in practice, there are pretty much as many counterexamples as examples for any path that you want to pick. And I think way too much time and mental energy gets spent on this. There are tons of examples of projects that did no airdrop or did huge airdrop or did long vesting or did cliff or ICO or non-ICO. And I think the uncomfortable truth for most companies is that really the largest determiner of token price is product market fit and brand loyalty, and that's a really difficult problem, and therefore it's not as fun to talk about versus how do we tweak these numbers back and forth.
So, I made a joke of this earlier, but to a large extent, I think depends on whether the question is things that matter for us to make money or things that matter for crypto in general. I do find the perps dex's craziness. Just, this is not, perps are great products. There are great products. The innovation is in the product creation, in the liquidity, ecosystem, et cetera. But once you have that, it just doesn't matter as much for the future of crypto. There will be a way to get liquidity on these tokens. There will be a way to get leverage. There will be a way to do price discovery. It'll be more centralized, it'll be less decentralized, but then kind of we go around the corners. Some of that resonates with me, which is we need provable, transparent on-chain execution, and anything that gets us there is fantastic and positive, and I like those portions of the discussion. I don't care about the rest, and there's a lot of that, just massive debate right now. Twitter's consumed by it. Liquidations, ADLs, it's the only thing we talk about right now, and that's just, it's cool. I'm an engineer too. I love talking about it, but it's kind of useless. On the prior question, actually, I was thinking about this one, but something that maybe it's a very hot take that is underappreciated is you have the government monetizing the dollar and basically inflating it away into the Cantillon effect. And then you saw Paxos minting $300 trillion on their stablecoin. And I'm thinking that maybe the thing that is actually underappreciated is a stablecoin issuer inflating their supply and actually making money that way. Maybe that's something that we're all missing in terms of an investment. You get a stablecoin to size, and then you just start printing and create a printing press. You truly became the Fed. Maybe that's, I would back a team that has this as a pitch.
These stablecoins are just treasury LSTs at this point anyways, right? So
100%. And on that topic, I won't put this in that category, but when we're thinking about what are some of the big red flags that you guys see when it comes to like evaluating investments, right? Or the things that people should be aware of that they can safeguard against that, again, automatically kind of turn you off. And it can be similar to like what we were just talking about in terms of things that people focus on. Cap table management is a great example. What are, you know, a couple of the big red flags you guys look out for? When you see it, you know it when you're looking at different investments.
When you talk with the founders and they're unable to give you a straight answer to the question of like, what problem are you solving? They haven't even thought about it, or if they have, it's a small problem. That's like a huge red flag.
One easy for me is X for Y, right? You know, it's hyperliquid, but for whatever chain, or it's like Polymarket, but for this thing. You know, those are all just. I understand that first mover advantage doesn't always win, and Google wasn't first, and Facebook wasn't first, but X for Y is always like such a big turnoff.
Both good answers. I think also like seed stage company that has like a token pie chart. It's like, come on. I mean, there's so many I could go through. I think founders who also like aren't honest or like aren't willing to say I don't know, or aren't willing to say I haven't figured this out yet. Like that's totally okay. Like but I think bullshitting smells really bad, and then it's like I'm going to find out anyway. So just don't do that. And then there's sort of this. I feel like it was like a tweet or something, but it's always kind of stuck with me. It's like. People who have revenue show revenue, and people who don't have revenue show like users and traction. People who don't have traction show like website visits or traffic, and people who don't have that show like social media follows. And like you can always almost tell the quality of the deck based on like which of those tiers they kind of fall into. So it's okay to not have amazing metrics. Just be honest with it. So.
And how do you guys feel the fundraising environment is right now?
So the debts are dead, for what it's worth. That has evaporated pretty quickly, and Friday was just like done. And after Friday, nobody will pick up your call, which is kind of an interesting one. In terms of fundraising in general for LPs, I think LPs behave in very different ways in the market. You'd expect, for example, to LPs to basically be a proxy for the price of Bitcoin. Price of Bitcoin is high, they invest. Price of Bitcoin is low, they don't invest. Lately, that has started to change a little bit. LPs are also extremely smart, and they care about the way that you make the money. And so it's kind of an interesting, a lot of people that made money on tokens are not getting any credit for it. It's like, hey, you returned 20x DPI, but I'm not going to participate in your next fund because, you lucked out. I don't think this is repeatable. You just invested in these tokens and you were able to hedge your position or get out very early. That is not a repeatable way of running a fund. That is not a repeatable type of business model. So I will not give you money. And so there's a lot of that out there in the market of a lot of these funds that got lucky or were really smart and didn't get lucky, but returned from things whose projects are not around. The LPs actually look. If the project is no longer around, and the project is no longer around, and you made money from it, you get no credit. And so there's a lot of that, unfortunately, in crypto. And so I think fundraising hasn't, from what I hear, been very easy for some funds.
I think it's also the divergence between paper marks and like TVPI versus DPI, because a lot of teams launch tokens, the funds will mark it at the top, and then the paper marks are massive, right? On paper, they've like done many turns of the fund, but then none of that is realized because it bleeds out, and folks hedge their bag and so on, or maybe they don't. Maybe the cost of hedging is too high. So then, what looks like okay for the fundraising season, like really good marks, the DPI is a lot lower, and I think LPs are getting a lot more sophisticated to like look at the float, what's the liquidity, what's the depth of liquidity on the order book for these tokens, and like why are you marking them at 100%? There's no illiquidity discount. Like, why? This is not proper accounting.
Yeah, I think as far as venture goes, there's certainly been like dispersion where I think some funds either are unable to raise a new vintage or they're just going to raise a much smaller vintage. I think we're seeing that kind of play out now. I think that's actually somewhat offset by the fact that like traditional VCs and allocators are actually like really ramping up into crypto, and I see them getting more and more involved. Not quite at like the 21 level, but kind of more so than even like 2 years ago. I think if your benchmark for like fundraising environment is like 2021, like it's certainly nowhere near that level of froth, and I don't think we'll get back there. And I think that's probably healthy, all things considered. But overall, I mean, I see hot rounds going pretty quickly, and like especially even for larger size investments, like those are also getting filled up quite quickly. So I think for again going back to dispersion, good companies, good startups, they can raise pretty easily, but it's not like people are slinging money around like they were 4 years ago.
And let me just say that the IPOs help a lot and the M&A helps a lot. It's just it takes a long time for LP lands to, this is not their focus, it's not their priority, to catch up onto the fact that there's real businesses, real equity businesses, real stuff that they just like understand. And so they can put the bucket into like a crypto VC much easier if they've seen IPOs and if they've seen equity versus just the token thing. And so I think that is filtering through, and I've already seen LPs calling me to do kind of like due diligence on potential new funds and potential new allocations. So there's life, and good funds can still raise.
Do you find yourselves underwriting more equity-based deals now, given this environment?
So look, I've always underwritten equity deals. I'm one of the few founders in crypto that didn't have a token, and so Anchorage is a bank. We're not going to launch a token. So equity has always been the thing that I've been drawn to because I've always looked for businesses, real revenue. Of course, you do equity with token warrants because it makes sense that the founders at the early stages don't know which path they're going to go. They shouldn't be forced to. That makes a lot of sense. And then on the later stage, we also look at liquids, and we allocate for funds, but we also do growth stage into equity and secondaries, which I've always found an amazing strategy. So at Haun Ventures, we've always had equity positions. And in fact, we were in Bridge, which sold to Stripe, and we were in Privy, which sold to Stripe. And we're in other companies that may or not be selling.
I would say generally when crypto founders say they want to go public, it used to be like a massive red flag because the businesses weren't compliant. There was no IPO window open. Now the window is like smashed open with Circle. So we've been able to underwrite investments such as Backpack. We're the first investors in Backpack Exchange. Those guys said they were going to do an IPO since the beginning. And the reality is, I think the best businesses are actually going to go public versus a token because the outcomes are just way larger. I mean, if you look at what Circle did, I would be shocked if they could pull that off in the crypto market because crypto traders have a higher cost of capital. They're more impatient. There's just a lot less wealth, and the float and the trading is thinly traded in crypto, and it's thickly traded in TradFi. And I think that's just like really underrated for the businesses that can do it, which is very few of them, but increasingly more.
Yeah, I mean, plus one to what all those guys said. I think it's like you show me the incentives, I show you the outcome. Even 2 years ago, there really was no opportunity to IPO in the U.S., and now you can, and so therefore we're seeing allocators shift that way. We're seeing founders shift that way. I think similar to Diogo, we almost always do like an equity plus a warrant structure to give founders the optionality, and a lot of people who didn't launch tokens in 22 and I discouraged them from launching tokens are like now very thankful that they like didn't sort of you can't unring the bell. But I think we still haven't really seen like the interplay between equity and tokens kind of play out. Like people know we're in this weird equilibrium, unstable equilibrium, where it's like, okay, it can't be both the case that like this labs thing is making a bunch of money and the token is also making a bunch of money. It feels like the two have to kind of play off each other in some way. And then similarly, it's like, is it really the case that if you IPO, you also don't get to issue a token? I don't know. I don't think those are like actually resolved questions.
Yeah, I think you're right. Actually, one point on Figure Markets, they consolidated all the pieces and then went public, traded up to like 9 billion, and they launched a token on SWI as well. So, and there's other networks that I think, for example, Aptos has huge potential now with what they're doing with Decibel, Shelby. It's one API for everything, and they're going to be able to actually capture the mind share of builders on the go forward in a major way. And just given the network is so performant, it's looking really good. But generally, what I've seen is like people say, okay, once you do the IPO, you can't do a token. But I think that assumption is going to also get tested.
I think the assumption is going to get tested, but one thing that is true is if you have a token, there's no M&A. Nobody's going to buy you. And so you just eliminated everything but IPO. So either you go out or you are a token. There's no one in between. So I think that one is worth considering. And lots of founders, like Tom was saying, are looking at this and thankful they didn't do tokens. And now they're telling me, Diogo, I was going to launch a token, but I'm not because I can be bought by an AI company for like 3 billion or 4 billion, and if I have a token, they will not buy me. And I know they will not buy me because they can't underwrite this thing. It's just like too weird, too awkward. Compliance will throw up all over it. Like there's just no way. And so they're holding off on tokens because they believe that their path is M&A. So that's kind of an interesting one, which is I agree for the IPO. It's being tested. There's one example, and maybe there will be more. That's easier-ish. But on the M&A side, just like if you have a token, you just can't be bought.
Yeah, and I love these types of events too because I think we probably have a pretty good mix of investors, builders, researchers, a bunch of different perspectives. If you guys were going to put your builder hats on right now quickly, if you were a builder today or a founder, right, starting up something new, where would you be spending 100% of your time? Tom, maybe we'll start with you because I feel like you've gotten the short end of the stick here.
Well,
In terms of order.
Oh, that's all good. I do think, I mean, not to kind of come back to this, but I do think there's something interesting happening in this intersection of like entertainment and finance. I think you're seeing this now with prediction markets being kind of merging with entertainment. Like you see all these streamers now have their own markets in their own stream. Pump is moving towards streaming. I think you're seeing that also in like, sports books and how those are being tailored. And so I'd probably do something in that realm. I don't quite know what it looks like, but I don't think we're at kind of the end state there. I also think like it's not as sexy, and I think it's weird as an investor because I'm like, I think this is a very difficult space to invest into, but something in identity, I think it's kind of a meme, but it's still very unproven. And I think if anything, it gets more and more important every year where we're at this point where there's just like huge wave of bots invading the internet. I think traditional forms of KYC, AML are basically failing and spoofable at this point. And we don't really have a good kind of next generation solution for this. So.
For me, it actually looks a lot like Shelby. I think so many venture dollars have gone into underwriting and scaling the rights of like TPS and getting block times shorter. Now, who's going to scale the reads and who's going to do the back-end services and do that at the edge, collapsing latency by 70 to 90%? Who's going to actually disrupt AWS? It's a $400 billion business. They have vendor lock-in. And I think you can actually do this in a much more hyper-localized way than people realize. Like these old CDNs and caching layers like Fastly, Akamai, they're like 25 years old. Median distance from the end consumer is like 200 miles. Like we can do a lot better than that in 2025.
Yeah, for me, look, I still spend a lot of time at Anchorage. So if it wasn't the bank, which I guess I'm on the board of two, I don't know how I found myself in that position. But I would probably go either compete or join somebody like Superstate. So I think it's really, really cool that we in crypto can actually go and solve the fact that the bar for IPO is extremely high. I think in crypto we can lower the bar for IPO and do on-chain IPOs first. And so what I mean by that is the truly IPO underwriting, take the traditional banks out of the equation, still have years of audited financial instruments, but instead of the bar being $500 million for you to go IPO, the bar should be something like 50. I think there's like 87% of the company. There's 87% of the companies in the United States market over $100 million that have an IPO. So there's so many companies that we can actually IPO if we found a way of automating, removing friction, and doing on-chain IPOs for a lot of these. And it's not lowering the bar for compliance, and it's not lowering the bar for transparency. It's just lowering the bar for revenue. I think that would be really cool if we could go on-chain first, use a lot of the efficiencies, remove all the money that the investment bankers are charging, remove all the money that TAs are charging, the ATS are charging, all this like infrastructure that is just like in there charging money that is just like, creating friction. We can take all of that out. And there's a path, a regulated path from the inside for us to do it. The second thing that I would do is crypto. We as VCs in crypto have poured billions of dollars into bleeding edge cryptography, in zero knowledge proofs, and fully homomorphic encryption. And I am of the belief that the value that will be created by this technology will be 5 orders of magnitude higher in everything outside of crypto than inside of crypto. And what I mean by that is if you truly have fully homomorphic encryption and efficient search that is private, you are much likelier to make all your money by replacing the current databases for banks and for all of the companies in the world than using scaling for an L1. That's totally irrelevant when you can actually literally have private search and efficient search on encrypted data. And so these positive externalities of cryptography that we've created would be something that I would be spending a lot of time on as a founder.
Yeah, and I think a lot of investing too is there's both the timing component and the sizing component to it, right? Like we saw in 2021, the rise up, and then 2022, that bear market, you could have the best asset doing the best type of thing. The fundamentals could look good. A lot of times it's oftentimes cyclical, right, with the way in which the crypto market goes. But the point being, the broader market and the direction of that obviously has a huge impact on the success, if you want to call it that, or how well some of these assets perform. How do you guys think about cycles, right? Do you subscribe to this is more of a kind of global liquidity macro cycle? Where do you think we are in that? Just from like an investor's point of view? Are we later stage? Like, are you still being aggressive when it comes to the amount of checks that you're writing, companies you're looking at? Are you slowing down deployment? Any insights into where you guys think we are right now?
I mean, just the way the duration of these venture investments work, it has to be a multi-cycle success for you to even be able to like get your initial money back. So what we saw was a lot of companies like OpenSea or others last cycle that obviously went really well in 21, but then drew down a ton. So generally, I would say it's a multi-cycle success. It's a better product that continues to accelerate throughout the business cycle. But generally, folks are looking at these venture investments, I think, also not realizing there's new business models being enabled, kind of like in 2009 when Facebook really started to go vertical in terms of the traction and the revenue. There was a global credit crunch. The markets of every economy was giga-wrecked, but Facebook just kept popping off because they had idiosyncratic flows and cash flow that didn't care about quantitative easing. It didn't care about bank bailouts. It didn't care about automobile bailouts. They were just growing super fast. And I think crypto can do the same and get those idiosyncratic flows. We just need better products.
Yeah, I mean, we're still deploying. I think I think you're right that hey, venture, like you said, it's these are really, really long fund life funds, and so that's really where you're going to make your returns is towards the tail end of the fund, not in the next 2 years or whatever. I do think there's obviously a path dependency where it's not just timing, but it's also doing the same idea now versus 2 years from now. Even if the market is 2 years from now, it's okay, are they actually fresh? Is the company well positioned? There's momentum to it. I think the thing I always worry about, and then if this starts to happen to me, I'll know I'll just retire from venture. Is you start to dismiss ideas because they've been tried before, and then therefore they're not going to work. And pretty much every idea that has worked in crypto, it was not the first one to do it, and oftentimes they're 5 years or 10 years after the first person to do it. But for a lot of reasons, hey, you can have the right ingredients in the market, in the team, whatever, for an idea to actually work this time around. And so I think it's always worthwhile actually to revisit old ideas that haven't worked and try to assess them from a fresh lens. Maybe now is the time that they're going to work.
Is there, to that point, is there anything, if you try to crystal ball this and look out 12 months, maybe 24 months, that you're really excited about, you wish existed today, could be a great product or business to start within this industry, but we maybe don't have the infrastructure, the timing is a little bit too early now, but maybe 12 to 24 months or 3 years from now, things could be different and the timing of that idea could really flourish?
Well, I think a lot of, especially equities and a lot of the RWA stuff fits square into that category, which is wrapping an SPV around some shares from OpenAI and trying to trade that is obviously not the final market structure. And there's so many things in between in terms of risk that we need an actual solution. So the actual solutions, there's many people trying to build different solutions for this, but we need an actual solution. And that will be 12 to 18 months from now. So I think that one is one that is fits squarely into the category. And by the way, RWAs are not one thing. There's so many different types of assets that need tokenized. All of them need that perfect solution. And so there's not one universal solution for them. So you have to go asset class by asset class and see what is the market structure, what is the regulation, what is the issuance, how do you actually do it in a correct way? Because only then can we actually have these things as collateral on chain, truly native in DeFi without restrictions. Because right now there's tons of restrictions. They can't trade freely, and they're derivatives, or they have a bunch of risk that is babushka dolls of risk until you actually get the ownership and the value at the end.
I think also thinking about one opportunity set that looms large is definitely the arb between on-chain rates and off-chain rates. You can generate a real rate of return in crypto that's extremely large. And I think a lot of people are starting to view these things more as a total return framework. It's less risk adjusted and sharp, and it's more everything's risky, everything could go up, could blow up. I want to make the most money with the least money possible, the financial nihilism frame, which I think is very real. It's the reason why people are trading 100x futures, and it's the reason why they're buying polymarket shares. But my point is, I think that arb between on-chain and off-chain rates really looms large as you think about personal finance apps like Credova or Bread, or putting this to work in a way where people can actually have the Web 2 flow, but you can subsidize their borrow rate or issue a ton of paper, commercial paper, whatever that looks like, I think that's still really unexplored, and like it's a huge opportunity.
Really quickly, because we're about to get the boot off stage, is there anything that we haven't talked about or haven't covered that you guys want to make sure we do or make sure we hit on?
I just wanted Tom to fight me more. I wanted some more disagreement.
I was
Do it on the podcast next time. There you go.
I was hoping someone would mention Dogecoin NFTs, but maybe I'm a cycle too late.
That idea has been tried.
Awesome. Thanks, guys. Thanks, everybody, for tuning in. Hopefully learned something. Really appreciate it.